Hello there. This is James, and welcome to another episode of the webinar series, which I'm doing called Market Bites, and part two, more importantly, of a sort of course I'm doing at the moment in relation to fundamental analysis. And today's episode, or today's little webinar we're going to be discussing, is going to be about fundamental analysis for currencies. And by chance, as we're doing this webinar, we're going to have a couple of events which we can look at together live as well, which is quite handy. Now, I do see two of my regular guys who come and support me. Assad, I see you there, and Fanzi, I see you there. Great to see both of you. So really lovely to see both of you. So thank you for coming. But before we get into the the guts, so to speak, of the webinar, don't forget these little webinars or videos, etc., are for educational purposes only, and in no way whatsoever should ever be taken as financial advice. I always suggest you do your own research, do your own due diligence, and of course, know the risks at hand before entering any trade. With that out of the way, let's get started. So let's start off with this presentation. Like I said, we did last week. Last week we did a fundamental analysis on commodities. Okay, and what we did is sort of establish with commodities, a lot of it, especially we talked a lot about gold. Assad, I'm talking to you. We talked a lot about gold. And we did discuss a lot about how commodities is really affected by supply and demand. Today, obviously, we're going to talk about currencies. And yes, there is always a bit of supply and demand in anything, but there's some other things as well when it comes to currencies. But anyway, let's get started. So anyway, a little bit about me. Again, I know you guys have seen this because you're regular, and I appreciate that a lot. But like I said, I've been in the financial services for 20 years. I started when I was 18. I'm now 46. Believe it or not, this good-looking face. No, I'm joking. I started off as an IFA in the UK, specializing in mortgages and obviously commercial financing. You know, I was a mortgage broker, and I actually, believe it or not, when I was in mortgages, predicted the crash of 2008 when I was doing mortgages. I realized what was going to happen. That's why I left the industry. I entered trading arena around 2006 when I traded gold through the Dubai Gold and Commodity Exchange. And as you all know, gold is my first love. It's the first thing I ever traded. First thing I have a romantic connection with because it's the first asset I've ever traded. Now, I worked for several very well-known brokers in my tenure in this industry, both as a portfolio manager and as an educator, which people tend to know me about. And I've been in trading education for over 10 years now. I'm a well-known public speaker. I've spoken on several massive expos and events, and I'm a published writer as well. I've published several theses and articles on the market. And like I've already said, I'm a well-known gold lover. Now, why I want to talk about fundamental analysis is because this is the origins I've come from. You know, when I traded gold, it was all about fundamental analysis. You know, it was all about supply and demand. And I think that long-term traders or position traders, which I am, we look for fundamentals more than anything else. It's not to say that technicals don't have a place in the market. They certainly do. But again, I tend to use technicals really for the purpose of confirming my belief in fundamentals, because I always look for the true value of something. You know, there's a reason why on Bloomberg, for example, they only ever talk about the fundamentals. They mention technicals a little bit, talk about 200 moving day averages, and that's it. But again, because though technicals have its place, it does depend on your trading style. I'm a true believer in trying to find a true value of an asset to see where it may go in the future. So this is why I want to do a course on this. And because I also think at the same time, everybody, every educators and everybody like that, they talk so much about technical analysis as like it's the secret answer to trading, and there's no secret answer to trading. Even fundamental analysis is no secret answer. So I do think there's a lot of that. The other thing about that as well, market sentiment always feels there has to be taken into account as well. So anyway, let's move on. So what is fundamental analysis? Back to basics. As we already know, it's the method of determining a asset's intrinsic value, the true value of an asset, when an asset is trading a price higher or lower than the actual value, the true value. So when the asset is trading below its true value, this is considered overvalued and is considered a buying opportunity. If the asset is trading above its true value, then it's considered overvalued and is considered a selling opportunity. So go through that again. Undervalued, but true value is more, buying. Overvalued, but true value is less, selling opportunity. And that's what we use fundamental analysis for, to try and establish the actual true value of something. And of course, fundamental analysis is not necessarily about short-term movements. Okay, it can be used for short-term movements like certain breaking news, which we'll discuss throughout this webinar. But at the same time, it tries to look past the short-term fluctuations at this moment to try and see the overall trend of an asset, where it may potentially go. And there's two types of fundamental analysis. There's quantitative and qualitative analysis. Now, quantitative, this is where investors looks at information to be shown using numbers, figures, ratios, and formulas. This is mainly for stocks, by the way, just so you know, and that's the next course we will do. And qualitative analysis, this is where the investors looks at the actual assets, the asset's quality, standard and nature. What does it really do? Again, this does a lot with stocks. But anyway, we're not talking about stocks today. We're talking about currencies, the value of the money in your pocket. Now, here's the question for you. What makes one currency stronger than another currency? Think about it. They're both made of the same bits of paper. Okay, it's not sort of one paper is laced with gold, is it? They're both made out of the same bit of paper. They both got the same sort of printing ink on it. But what makes one currency stronger than another currency? The theory is a strong economy equals a strong currency. So the stronger the economy is, or the future strength of a currency is, the stronger a currency may be. Assets typing to me here, buddy. Good to see you, by the way. Yes, very, very true. The reserve currency status, again, that's demand, though, isn't it? Trade balance is all economic stuff. That's correct. That's how you gold reserves, man. Well, we left the gold standard, but gold reserves does have a key part of that, yeah. Let's see what else. Good point, though. Very good point. But again, all that equals to a strong economy, though, doesn't it? Certainly, basically, if your currency is a reserve currency, like obviously exports reserve currency status 100%, yeah, you're right. It all goes to that. Because that's obviously, if you're going to talk, excuse me, about the biggest reserve currencies, you've got the likes of, obviously, the dollar's the biggest currency reserve, followed by the euro. Then it's, I think it's the Japanese yen. Because I know yen and the sterling, sorry, tend to float and change their status. But yes, that's all a key part of it. Again, all links to the strength of the economy, obviously. So there we go, that's the right button. So anyway, we're going to go through some key economic indicators, some key ones. And like I say, at this very moment in time, actually, we do have one of these announcements actually happening. So we'll have a little time, as it's just the three of us by the looks of things, to have a look at the chart and have a conversation about it, which I think would be really nice. Anyway, let's go through some of the key data, employment data, and non-farm payroll. We You know what that is? Unemployment rate, retail sales, gross domestic product, consumer price index, interest rate decisions, and of course, press conferences. Which one? We got one happening in 30 minutes, actually. Now, let's go for this. Employment data, non-farm payroll, okay, is released usually on the first Friday of every month. Not always, because on certain holiday periods where they haven't had enough time to ascertain the information, it may be the following week, like it did it in January because of obviously the Christmas season. Now, again, this is key job growth data for the United States, as it's the number of new jobs created, not including farm workers and the military. Hence the title, non-farm payroll. Incredibly imaginative title. Now, usually, as a rule of thumb, we're going to talk about this because it's not as simple as this. If the number comes in higher than expected, it indicates job growth in the US and the economy, which can potentially mean that obviously the dollar will gain strength against the likes of the euro, sterling, Swiss franc, and Japanese yen. That's the theory behind it. And quite often it does. But this is where a part of fundamental analysis also really connects with market sentiment. And I will do a course on market sentiment as well. Because the market sentiment is something different. And then occasionally you can do the opposite to that because the market is thinking something different. But that's a conversation for another time. Well, we'll dissect that a lot more. Unemployment rate, of course, it makes sense. Unemployment rate measures the number of or the percentage of people unemployed in that country. If the percentage is increasing, then clearly, means more people are out of work, resulting in less money going into the system, which we'll talk about in a minute, and the cost for unemployment benefits, so more strain on the government and the economy. And of course, when it affects the economy, it obviously affects the potential value of that country's currency. Before I move on to that one, actually, let me go back. There is another one, which is a weekly one. It's, again, not necessarily a massive market mover, but it's worth taking a note of. And that is the US initial claims. That's once a week. It's released, and it's the total number of American citizens who are claiming unemployment benefit for the first time. Okay, unemployment benefit for the first time. Now it's weekly. It's not massive. It doesn't get the sort of attention as non-farm does or unemployment does. But because it's weekly, I like to observe it because sometimes I look at it as a little bit like an early warning indicator. Okay, where you can, if you can start to see it creep up, then maybe that's indicating that the labor market might be in trouble. Okay, so I always pay attention. I call it a canary in the coal mine. Back in coal mines, they used to take canaries down to make sure it wasn't too dangerous. If something happened to the canary, then they realize, yes, it's dangerous. They have to leave. So it's like an early warning indicator. So, I always find it interesting, especially considering last week, obviously, it came in at like a 10-week high last week. So it's interesting to see what it comes out with today because it's being released today. Anyway, so that was a side note. I want to add that bit onto it. Retail sales and consumer confidence. Again, here's the thing. The modern day world economy is driven by us spending our money. It measures a key indicator, which is where retail sales record the value of the sale transaction between retail business and the consumer. Now, this is released monthly, and if the number is growing, it indicates we are spending our money, that the consumer is confident, so they're feeling good, which results in more capital, again, going into our system, meaning the economy is growing, and so could that country's currency. Because it makes sense. We're spending more money on clothes, iPhones, then obviously it adds money into retail and then manufacturing and then the produce we use to make such things. So it's all good if it's growing. If it's not, then that means people are getting a teeny weeny bit worried about stuff. And consumer confidence is a big thing, because don't forget, we had a consumer confidence a couple of weeks ago in the US, and it was very bad. It wasn't good. Now, consumer confidence obviously is an economic indicator that measures how optimistic or pessimistic consumers feel about the state of the economy and their own financial situation. It registers activities of them saving or spending. If they're confident in the state of the economy and the amount of money they have in their pocket, then they're most likely to spend their money a lot more. And I'm not just talking about groceries. I'm talking about luxury items. I'm talking about phones. I'm talking about watches, things like that. And that way it puts a lot of money back into the economy, which of course is good for the economy and is also good for the currency in question. On the flip side, if the confidence is falling, like we had a couple of weeks ago in the US, it means the consumer is nervous and less likely to spend their money. Instead, they probably save their money for essentials like groceries. And it means the economy may decline. And again, this could potentially affect that currency's value. Gross domestic product. Again, this is quite a big thing to keep an eye on. This measures the overall health of a country's economy. If the percentage is increasing, indicates the country economy is growing, and so could the value of that country's currency. If the percentage is falling, it indicates that country's economy is struggling. And if it proceeds to fall, then the country may fall into a recession. If that happens, then the country currency could also fall in value. So again, it's a health gauge, how healthy that currency is. Gross domestic product. Whoops. CPI, Consumer Price Index. Back in 2022, just so you know, I had another live show for another brokerage. And this was 2022. If you might recall, we were in the height of a massive inflation problem. And I talked nothing about CPI and consumer. And I tell you, this was a market mover back then. This was huge for the market. And I'm about to go to the reasons why it can potentially be so big, especially if it's rising. Now, the Consumer Price Index measures the value of the basket of goods, in other words, inflation. Okay. If inflation is rising, it means it's getting more expensive, obviously, for us consumers to purchase items, which means that the consumer will most likely spend money on essentials, meaning less money going into the economy. The inflation is decreasing. It means that goods are becoming cheaper to purchase, resulting in the consumer most likely spend more and boost the economy. So if things are cheaper, they've got more free cash, haven't they? So indeed, I can go and buy the more expensive iPhone. This is a Samsung, by the way. Or I can buy, that extra special car I want. You know what I mean? So again, it's a good thing because it gives us more flexibility of cash. If it isn't, then obviously I've got to be more concerned with buying eggs. Like we have the egg crisis in the US at the moment. Things like that. And this obviously, all this leads, all these bits and pieces really leads to interest rate decisions. Because central banks tend to do one of two things. Okay? And one is known as tightening. The other known as loosening. Everything we've discussed basically leads to this. Okay? Tightening. This is when they do this. They tighten when the economy is booming, inflation is rising, and the central bank will then look to increase interest rates as A, for one, they feel the economy is performing and it can handle it. B, to try and bring inflation down. And C, to encourage us to save our money due to higher interest rates. So that's why they do it, when they're confident. And there's another thing I'll add to this in a minute, which I'll talk about in my live show later this afternoon. And that's why they do. When things are good, they tend to raise interest rates. They're like, yeah, or they're fighting inflation, which is another point. It's the whole point I want to talk about. The other thing they do is loosening. This is when the economy is under pressure and struggling. So what a central bank will look to do, okay, is decrease interest rates to try and encourage us to borrow, because it's cheaper to borrow. It's saying it's cheaper for companies to borrow. Well, that way, they're hoping that obviously they will inject some life into the market. Now, in practical theory, this is what I want to talk about with this. In practical theory, when someone's tightening, okay, or raising interest rates, in theory, that should make the currency stronger. And I'll say why. Okay, A, for one, it means the economy is strong. So it's a good sign. Remember, a strong economy equals a strong currency. As well as that, higher interest rates means that you're going to likely to encourage more foreign investment, because obviously foreign investment, if they're going to get higher interest rates with your country and your banks, they're going to carry trade impact. Very, very good. Yes, very good. It does. Yes, good point. That's a very good point, mate. So with higher interest, you do actually then, encourage foreign investment. Loosening means you're in trouble. So you're having to inject steroids into the market. That's the thing. However, again, this is really connected to market sentiment, because you really need to know how the market is feeling. Because occasionally when they see tightening, okay, they'll see that, okay, well, we're nervous that the market can't take it. Like back in 2022, when the Fed was obsessed, absolutely obsessed with tackling inflation, because it was 9.3, I think it got to back then. They were raising interest rates, and there was a general worry back then that the US could not handle it and it would end up falling into recession. So it had the negative effect to the market. The same with loosening. Again, like I say, loosening, okay, really is only used when the central bank feels the market is not, or the economy is not doing so well. So that should be a negative thing. But sometimes the sentiment can be like they did when the Fed held rates the other day. Well, actually, we're hoping you to cut rates to inject more life, so it can have a negative effect. So again, this is the problem. It's not as straight-laced as saying, well, they definitely do that. That will make the currency stronger. No, you need to understand sentiment as well, what the market's talking about, to understand these sort of reactions. And the final thing I want to talk about, which by chance is starting in 15 minutes. Actually, before we do that, should we have a quick look, see what the ECB did with interest rates? I think we all know what they were going to do, because that happened just under 15 minutes ago. Okay, as anticipated, they reduced interest rates by 25 basic points. So the interest rate now is 2.5. So that was pretty much anticipated. So it's probably priced in already. So it was expected. Really now it's going to be the press conference in a little while. But let's have to talk about this. And then maybe we can watch the press conference together for a bit. So all major central banks holds on a regular basis press conferences, usually after they've made an interest rate decision. Sometimes, like for the UK, they do monetary policy report, which is separate from the interest rate, and the Fed obviously do the FOMC minutes, which tells what their decision was or what led them to the decision to make that interest rate decision. Now, obviously, we watch all these press conferences very, 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 very closely, because we try and look for the tone of what the speaker or the person or who's saying it, what it is, what the tone is like. If it's hawkish, And this is again what we look at for these words. Excuse me. Excuse me. If the tone of the press conference is described as hawkish, this means the tone made at the press conference is more aggressive and they're confident. They're speaking about quite fondly of the market. They're thinking, yeah, the market is strong. And this indicates potential interest rate hikes in the future. And then again, if there's potential rate hikes and the press conference is hawkish, they're also talking positive about the economy, then this can lead to currency strength. And these individuals are called hawks, obviously. Those people, those central bankers, and I said central bankers, are called hawks. The other type is dovish. Now, this is where the tone of the press conference is more cautious and negative on the economic outlook, which could indicate there may be rate cuts in the future. So they're a bit more nervous. They're a bit like, yeah, okay, the economy is not doing so amazing. It's not doing so well. We might have to inject some life into it. And this tends to have a negative effect on the currency. So, and these individuals are called doves, obviously. Now, the reason why we use the expression hawkish, dovish, hawks, and doves is hawks, the animal, is a quite aggressive bird. It's a bird of prey. And doves are quite timid. So this is why we tend to use them. So anyway, that's a bit of a rundown of press conferences. There's one other thing I want to talk about, which is, again, quite key to currencies, certainly in the current climate we're living in, and that is politics. Politics. Now, political turmoil and natural disasters and war, obviously, can have a profound effect on the currency markets. Election results can also impact a currency, as a change in government also means a change, obviously, in economic policy. Now, for example, if you have a political party which wishes to encourage growth, they're going to spend, and they look at it and go, like, we want to inject life, then it could indeed strengthen the currency. Whereas a political party looking to save or reduce, say they've got a bit large deficit, so they're going to have to make cuts on spending, raise taxes, things of that nature, then it can indeed weaken a currency. Prime example of this scenario. Okay, let's look at the euro right now. We're going to look at the euro. Why not? It's the three of us. Why not spend a bit more time together? Why not? You look at the euro. Now, euro is currently trading. Let's see where it is trading, actually, in case I've changed and everything's gone. I'm talking rubbish. Let's have a quick look, see where it is very quickly. Bear with me. I want to check quickly. Okay. Let's have a quick look what the currency is. Yeah, so euro is still trading 1.08. I'd like to say, so give that as an example, a prime example. Okay, obviously the euro has been boosted by several things currently at the moment. We got a slightly weaker dollar, but obviously we've got Germany spending its money to boost infrastructure and obviously defense spending. At the same time, you've got the same sort of thing coming from the EU. So obviously you've got people wanting to spend, which boosts the euro. Let's look on something else. What happened to the sterling a couple of months back when the change of government came in, which is the Labour Party, and they wanted to save because they claimed there was a massive deficit. There was a black hole with the money they had, so they had to save. This impacted the sterling negatively. So this is the sort of thing we need to be careful with politics. Look at the current situation now with the United States, obviously, with tariffs, with, President Trump wanting to pose sort of monetary changes. So again, politics, this day and age, tends to be a really, really big thing. Okay, look at Brexit back in 2016. Look at Brexit. What happened when, not me, I'm a Brit, by the way. I couldn't vote because I live in Cyprus, but I wanted to vote. I would have voted to remain because it was a silly decision to leave. But look at the decision, what happened to the sterling, So again, these are sort of things you've got to be aware of. And again, with politics, when there's rumor of certain parties getting in, like maybe right-wing parties, people anti-EU, for example, if it's Europe or something of this nature, then yeah, it can tend to be a massive impact. So again, you need to base yourself, not base yourself, be aware of that. Any questions at all on what we discussed, or any other people's opinions on what's happening at the moment? Well, perhaps we'll have a quick look, like I say, at what the euro is going to do with this press conference. Anybody any questions? All share opinions? I got a question going. Excellent. What about the crosses? Never really understood how it moves. Are you talking about currency pairs, or you're talking about currency pairs? So say he's got euro dollar, for example. How that works? Is that right? Is that your question? Am I right on that? Yes. Okay. Well, okay. All right. How it works. So you got the euro, you got the dollar. Okay. What the market does, again, is tries to look at, unlike like the intrinsic value for something like a commodity, they look for like the true value of that country's economy, not just now, but where that country's economy is going to likely to be in the future, like 6 months, 12 months, 18 months down the line. If they think the economy is going to be better compared to the economy, say, of the US, then they're going to long the euro. Okay. The same as what you're seeing at the moment with the euro dollar. Okay. Because they're spending in the euro, as well as that, because there is a lot of investment at the moment going into global stocks, like that's why euro stocks are doing so well. Obviously, it's euro stocks, it's the DAX, it's the Euro Stock 50. So obviously, the euro is going to be doing slightly better than the dollar, because at the moment, people are looking at the US and they're going, okay, there's slowdown in a couple of areas. This tariffs is going to hurt the US just as much as everybody else, maybe even more so. And consumer confidence dropping. So, and they're not going to be able to spend what they're spending, they're cutting. Whereas the euro is investing into defense and infrastructure. There is foreign investment going to global stocks, whereas the US stocks, people are sort of bailing at the moment because they consider like a lot of things be overvalued, which I think they may have a point. So this is why. So that's how the crosses work. Okay. Prime example of how it works. It's like if we take, for example, a case in 2022 when the UK went through a number of different prime ministers, one being Liz Truss, absolute disaster. It was total disaster. She came out with a load of tax breaks, lower taxes to try and put life in the economy. The market looked at it and went, the UK economy can't handle that. That's not a good idea. Don't do that. We can handle it. And then what happened? The sterling fell against the euro because the market saw that's bad news for the sterling. Nothing's bad happening with the euro. Nothing bad's happening with the dollar. So the sterling tanked. So that's how it works. So again, you're looking at one country's future or current economic situation and potential future economic situation compared to another. So that's how that works. But great question, mate. Brilliant question. Assad, I think you're writing me a novel. Looking forward to this. Good question, by the way. All right, I have two questions. Why? Number one, why euro has risen in this week? Could not hear what you mentioned about it. Okay, I'll go over that and I'll go to your second question. Right. The reason why we're seeing a boost in the euro, okay, there's a number of reasons. One, okay, we do have a weaker US dollar. Okay, that's why we're seeing the dollar index 4-month low. So that's one factor we've got to play in it. The other reason, okay, is that over the last couple of days, both Germany and the EU have committed to spending more money, okay, on defense, okay, and infrastructure. In fact, Germany is going to let loose something like 650 billion, okay, because of the realities that they think they can't rely on the United States to be an ally anymore. They're trying to back themselves up. So that's one reason. So there's more money being spent. And Germany's the biggest economy in the EU, in the Eurozone, don't forget. So, and in the EU. So that's giving it a bit of a boost. The other reason why the euro is doing quite well at the moment is because Bank of America did this. They did a survey of this back in January. Whereas in the end of December, they asked a load of money managers and they all believed that they're still going to invest in US equities. Come January, there was a larger percentage of money managers putting money into global stocks, including European stocks. Okay. And 22% of those people asked wanted to put their money in gold. Only 18% of the money managers asked wanted to put in US equities. So what you've also got going on, okay, you've got the European stocks at the moment outperforming the US stocks, like the DAX hit an all-time high yesterday. Okay. And you had the likes of Euro stock hitting all-time highs. So again, you've got the fluctuation of a weaker dollar, the defense spending boosting it. You've got and European stocks performing really well, better than US stocks. So that's giving the euro a bit of a boost at the moment. So that's helping it. Okay, and number two, do you observe correlation? That's a great question. Great question, by the way. Do you observe the correlation between currencies of certain currencies and metals, copper, gold, platinum, that they produce? Like these days, copper and Australian don't have a good correlation, and copper goes up first, and then Aussie dollar follows. Well, yes, obviously there is. First of all, I'm really big on currency correlations in particular. Okay. I always look at because I always think, and I will do a topic on this at some point, because I always think if you understand currency correlations, A, you understand how to diversify your portfolio, and B, you also understand how to hedge. Now, in relation to commodities, yes, there is such thing as commodity currencies. Okay, because then you look at what countries produce those type of commodities. Okay, so say for example, Australia, you made a very valid point. Yes, because it does produce a lot of copper. So that's why. Aussie dollar is also heavily linked to gold because it produces a lot of gold. So if demand of gold goes up, then it's got gold. The same if you've got likes of the loonie, Canadian dollar, it's a commodity currency because they produce oil. Same with the Norwegian krona. So if oil prices go up and oil demand goes up, then obviously this has a positive effect on their currencies. If the commodity falls and etc., the supply and the demand falls, then it can have a negative impact. So yeah, you do take it into account as well. But I'll be realistic to you. Unless there is a massive thing about a certain commodity, I tend to look more at the economic situation of a country to try and adjust the value of the currency more than what the commodity is doing. Correlations, yes, currency correlations, I do pay a lot close attention to. I'm a big believer in that, and I will do a course on that. But yeah, great question. Really, really, really good question. Any other questions at all? I think we have a. Is there a Billy I can see here? Do you have any questions, Billy? Oh, how's that again? Excellent, good man. That's brilliant, buddy. Thanks, sir. Due to your previous webinar, I started seeing commodities. Thanks so much. Dude, my friend, this is what I'm here for. No, thank you, Assad. That's really good. Like I say, I'm a big believer in one of the most valuable things about trading is having an idea and not just being stuck in one sector, but being aware of other sectors, other things, and other bits and pieces. Being aware of bits and understanding that the whole picture. There is no correct answer. There's no necessarily perfect, successful solution. It's a case of finding yourself really with it and finding, controlling risk and bit by bit. But it's a good idea to get the overall idea of the industry so you have other opportunities you can look at and not just be stuck on, say, currencies or this or that. But at the same time, be aware of diversification, protecting yourself. I was just looking at gold, but now I see a lot of other. I know, yeah, it's brilliant. Like I say again, copper is an industrial metal. I love soft commodities. I really do. I like softs every now and then when I can see an opportunity with them. Not a lot of people trade soft commodities, which is fair enough because they're not necessarily so dramatic. They're more position trading. They're good for position traders. That's brilliant. So we have a quick look. Let me have a quick check. See if there's anything said so far. The press conference has just started. So perfect timing, really. We're talking about fundamentals for currencies, and the press conference has just started. I'm going to have a quick look, see if I can see anything being said. Just out of interest. Hmm. Can't see. I don't think. I'm not sure they've gone live yet. Can't see anything. No, I'm saying I don't think that she's gone live yet. But anyway, is there any other questions at all? Anybody else like to ask me anything? No. Okie dokie. Okie dokie. There's no further questions. Don't forget. Thank you so much. Now, Assad, thank you so much for coming, buddy. I really appreciate it. You're like my, you're like my number one fan, both you and Fazim. Honestly, guys, I appreciate you guys coming. I really, 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 really do. Now, before I go though, can I have a show of hands? Do you want me to do fundamentals on stocks next week, or do you want me to do a different topic? You let me know. What do you want me to do? Do you want me to do a separate topic, or do you want me to do fundamentals on stocks? Because they're very different. A different thing altogether. So, Assad, what do you reckon? Do you want me to do stocks? Okay, all right. So you already know stocks. How about you, Basil? Do you want me to do stocks fundamentals for stocks? Because there's quite an in-depth subject to go into. Because there's a lot more to it than just numbers when it comes to stocks. A lot more to it. Oh, bless you. I'm fine with whatever you give us. Okay. All right. So okay, we got move to market sentiment and hedging. Okie dokie. All right, look, we'll do market sentiment next week. I do want to do stocks at some point because I mean, for one, we'll do market sentiment, okay, just to shake it up a little bit, just to do something a bit different. Because I think I talked about market sentiment a lot, and I think it's really important to understand it. I really do. And then we'll do stocks another time because I think there's more to stocks than I mean the quantitative and qualitative fundamental analysis is really for stocks because obviously you got to look at value and stuff like that, but you got to look at who's leading the ship, like what's going on with Tesla right now. You know, Musk is damaging his own company with his behavior at the moment. So you got little things like that you got to sort of take into account. But we'll do market sentiment next week, and then maybe we'll do stocks the following week. But we'll do market sentiment just to shake it up a little, just to be a bit different. Should be great. Excellent. Awesome, guys. Awesome, awesome, awesome. Don't forget, of course, I go live as well every day on YouTube. And that's more just talking about the market, what's going on. So feel free to be, it's usually about 10 past 3 GMT, about 5 past, I remember, about 3 p.m. GMT. Oh, got to mention, tomorrow I'm going to be doing a live broadcast. I call it a watch along, where I will be watching the NFP event come out, see the NFP happen. So, and we'll talk about scenarios and we'll look at the market together as it happens. So that's at 3, it starts at 1:15 p.m. GMT because I go on 15 minutes before the actual event. And then as the event unfolds, we watch it together and we talk about it. So feel free to join me tomorrow. It's going to be on YouTube again. I think it's already scheduled. You'll see it. You know, if you're not already subscribed, notification, you'll get, you know, you'll find out about it tomorrow. And that's going to be a good show. That's going to be good. Brilliant. That'd be excellent. That'd be absolutely superb, guys. It really, really would. Anyway, once again, thank you so much for coming, guys. Thank you so much for your excellent questions as well. As always, brilliant conversation. I really, really, really enjoy it. But anyway, till next time, till tomorrow or till later or till whenever we speak again or next week. Till next time, don't forget, these little webinars slash videos are for educational purposes only and in no way whatsoever should ever be taken as financial advice. I always suggest you do your own research, do your due diligence, and of course, know the risks at hand before entering any trade. Till next time, every single one of you, trade safe.